In today's macroeconomic analysis, we will take a look at the most important macroeconomic data points released so far this week, including the JOLTS data for December, the ISM Services PMI data, as well as the ADP employment report. And we will talk about why this data is important to the bond and the equity market. And we will also explain what this data tells us about the future path of monetary policy in the United States. But before we take a look at the JOLTS data for December, it is very important to understand the relationship that is explained by the so-called beverage curve. And we need to use this beverage curve framework to analyze the JOLTS data and truly understand what the implications of this data are for monetary policy. So before we proceed, we will create this beverage curve within the RStudio environment. And as always, the first step is to import the necessary data and also rename the data sets. Before we proceed, let me explain what relationship the beverage curve portrays. The beverage curve explains the relationship between the unemployment rate and the job vacancy rate. The job vacancy rate is calculated by essentially taking the number of job openings and dividing by the sum of the employment level and the unemployment level. And this relationship is non-linear, which is why, in order to plot this beverage curve, we're going to fit a linear polynomial model, which allows us to portray the nonlinear relationship between those two variables. And then, after fitting this polynomial regression model, we're going to create a scatter plot and add this line of best fit to that plot. And then you can already see that we have a beautiful nonlinear relationship here between the unemployment rate and the job vacancy rate. So what this relationship tells us is essentially that when we are, over here on the beverage curve at a higher point on the beverage curve, then a 1 percentage point decline in the vacancy rate will lead to a less significant rise in the unemployment rate as opposed to the same 1 percentage point drop in the vacancy rate at a lower part of the beverage curve. And it is very important to understand this nonlinear relationship because what we have seen in the past few months, or rather, coming out of the COVID pandemic, is a significant decline in the amount of job openings, which means that we slid down this beverage curve to a point where a further decline in job openings would likely be associated with a greater rise in the unemployment rate. And that was always sort of a key source of risk that I always pointed to because a few months ago, job openings still showed a significant downward trend. So now that we understand this nonlinear relationship between the unemployment rate and the vacancy rate, let's take a look at the most recent job openings data. Now, what we saw in December is a drop in job openings to 7,600,000, as indicated by the bar plot on the right-hand side of your screen. And that's a drop from a revised 8,160,000. When we compute the mean and the standard deviation and the one standard deviation upper band using data from 2010 to 2019, and then plot this one standard deviation upper band, so the average plus one standard deviation on the bar plot, we can see that while job openings did decline in December, they still remain above the one standard deviation upper band from 2010 to 2019. And looking at this chart, we can also see that job openings, in my opinion, still seem to stabilize at the current level, and we're not seeing a continuation of the downward momentum that we still saw a few months ago. But we cannot judge the JOLTS report using just the job openings data. There are some other valuable employment data points within the JOLTS report. And as always, it is very important to look at the totality of the macroeconomic data. So the next data point that we're going to look at is the hiring rate. And what we saw in December is the hiring rate remained unchanged at 3.4%. But when we compute the standard deviation and the mean and the one standard deviation lower band, which is the mean minus one standard deviation, and then plot the mean as well as the one standard deviation lower band, with the one standard deviation lower band being the bottom line here, we can see that currently the hiring rate is slightly above the one standard deviation lower band and below the average from 2010 to 2019, which tells us that the hiring rate at the moment is quite low. So we're basically in an environment where hiring is very weak. However, when we take a look at layoffs and we conduct the exact same analysis for layoffs, we can see that the layoffs and discharges rate is below the mean from 2010 to 2019. In fact, it is below the one standard deviation lower band. So this supports the narrative that we continue to remain in this low hiring, low firing environment in the US economy. And then when we take a look at the quits rate and we conduct the exact same analysis, we can see that the quits rate currently remains above the mean from 2010 to 2019, but slightly below the one standard deviation upper band. So what is the bottom line of this data? Looking at the JOLTS data tells me that the labor market is still in a healthy condition. It may be moderating at a very modest pace. Labor market conditions may be cooling at a modest pace, but I'm leaning towards the narrative that labor market conditions are actually stabilizing at the current level. We're seeing the quits rate remain unchanged and still, a bit elevated, which certainly tells us, and let me just make sure that we're actually looking at the right plots here. One standard deviation upper band. Yes, we remain slightly below the one standard deviation upper band. The quits rate tells me that labor market conditions are still quite healthy because the quits rate tells you how many people are voluntarily leaving their job. It's a measure of confidence that people have in finding a new job when labor market conditions are tight. The quits rate tends to be higher because people leave their current job to find a potentially better paying job. So the fact that the quits rate remained unchanged gives me the signal that labor market conditions are still in a healthy position and seem to be stabilizing actually at the current level. When we take a look at the layoff rate, the layoffs and discharges rate, that tells me also that labor market conditions are still in a healthy position because layoffs still remain super, super low. However, the hiring rate does remain low, and also job openings did moderate somewhat in December. So the bottom line is either labor market conditions are stabilizing or they're cooling modestly. But the bottom line is that currently the labor market conditions, at least, do not give the Fed a reason to cut. And then when we combine this with the ADP employment report, which showed that the US economy apparently added 186,000 jobs, that is still a solid pace of job growth in the US economy. We, of course, have to wait until the crucial Friday jobs report for January. But the bottom line is that the US economy is still very resilient. And this is also the narrative that was conveyed by the most recent GDP report, the most recent PCE report. Inflation remains on the sticky side. Then you add the potential, you add the uncertainty surrounding the Trump policies and the impact on the economy. And when you combine the totality of the data, we continue to remain in this environment where the Fed will likely stay on hold. Be patient, especially when you take into account that the inflation data has been more on the sticky side in the past few months.